In the current day and age, almost everyone has a bank account, a place where you keep your money. And if you don't have a bank account, go and open one. And so today, one of the most important things we can learn and be aware of are these 6 different types of bank charges. I'm going to take you through some of the bank charges, what they are, why it is important to know, and what you should ask to get this kind of information. Bank charge number 1, management fees. Management fees is the charge a bank or financial institution deducts to manage or maintain your account or investment. It is common in interest earning accounts such as money market funds and other types of investment fund. This fee is calculated in 2 main ways. Number 1, as a percentage of your interest earned, and number 2, as a percentage of the total balance. That is the principal plus interest. To make it make sense, let me explain using these 2 scenarios. Scenario 1, we are going to calculate it as a percentage of interest earned. Let's say, for example, you invest 100,000 in a money market fund that earns an average interest of 10% per year. Management fee is 2% of the interest earned, that is 10,000 to get 200 as the management fee you are going to pay. So the net earnings after deduction of management fee will be 10,000 minus 200 to get 9,800. After this deduction, your effective return drops from the original 10% to 9.8% of your initial investment. Moving on to scenario number 2, as a percentage of the total balance, that is principal plus interest. If management fee is charged on the total balance, let's say the principal amount is the same 100,000, interest earned will be the same 10,000, your total balance will be 110,000. To get management fee, you are going to take 2% of the total, which is 110, to get 2,200 as the management fee that you are going to pay. The net earnings after management fee will be 10,000, the interest you earn, minus 2,200 to get you to 7,800. After this deduction, your effective return drops from the original 10% to 7.8% of your initial investment. Tip number 1, always ask how management fee is charged. If it is charged on interest, the impact is small. If it is charged on the total balance, your returns drop significantly. Also check whether the quoted interest rate is the gross or net. Some funds advertise rates after management fees, while others quote before. Before signing any agreement, always read and ask the questions if you don't understand the terms. Here are some of the questions you can be able to ask the bank in order to obtain this kind of information. You can ask, is there a management fee or a maintenance fee on this type of account that I am opening? Now, the second question you can ask is, how much is it, if it is there? Is it charged on the total balance or the interest earned? If it is charged on a monthly basis or quarterly or yearly, you need to know all this type of information. Bank charge number 2. This is not a bank charge per se, but a government charge. It is a charge by the tax authority when you use certain products offered by the bank. For example, when you earn interest or investment income from a financial product such as money market fund or fixed deposit account, that income is taxable at different rates depending on the applicable tax law of your country. Government often tax interest earned on savings or deposit. In Kenya, for instance, the interest earned is subject to 15% withholding tax, meaning the tax is automatically deducted before you receive your earnings. You may expect to receive a certain amount in interest, but after tax it will be lower. Let's make it make sense. We will continue using the first scenario we mentioned while discussing the management fee, whereby scenario 1, the principal amount was 100,000 the interest earned was 10,000 and the management fee was being charged at 2% to get 200. The net earnings minus the management fee, we were getting at 9,800. When we apply taxation, let's say the withholding tax at 15% of the interest earned, that will be 15% of the 10,000, which is 1,500. So your net earnings that lands into your account will be 10,000 minus 1,500 minus 200 to get 8,300. If management fee is charged on total balance, that is 110,000. For scenario 2, management fee will be 2,200. Net earnings that will land your account will now be 10,000 minus 1,500 minus 2,200, and your net earnings that will go into your account is 6,300. You can clearly see the impact of management fee being charged on the total balance, and when it is charged on interest, you will save 2,000 if the management fee is charged on interest earned as compared when it is charged on total balance. Some of the questions you can ask the bank are, do I need to declare this income separately for tax purposes? From what I've seen with most banks, they deduct and remit withholding tax directly to the Kenya Revenue Authority, but you must ask to know if this is the case or otherwise. Number 2, you can ask, are there tax-free account options available? There are tax-free options such as retirement savings account. There are some which are tax-free up to a certain threshold of saving. Speaking of which, I have an upcoming video on tax-free account. Bank charge number 3. Internet banking charges. Internet banking, also known as online banking or e-banking, is a digital service platform that allows bank customers to access and manage their accounts through the internet using computer, smartphone, or tablet without the need to visit a physical branch. It means doing your banking activities online at any time, anywhere. Common services include checking your account balance and transaction history, transferring money from your account to another person, paying bills and loans, downloading account statements, applying for loans, debit card and credit card transactions. All this can be found within the internet banking. Major benefits of internet banking is that you can bank 24/7 from anywhere without you necessarily going to the bank. It is important to know about internet banking charges since most transactions nowadays are now digital. Hidden fees can add up and build up to significant amounts. It's better to know so that you are aware of what you are parting with in order to get the convenience that online banking provide. So for me, I have 2 bank accounts with different banks, and the convenience of not going physically to the bank is worth it. Maybe someday it might be different, but as of the day of recording this video, I would say internet banking is a better option. So these are the kind of questions to ask regarding the internet banking charges. Number 1, are there charges for accessing the internet banking? What I've seen is that there are some services that are free and some that are charged for accessing the online banking. Inquire to know which ones are free and which ones are charged. How much is charged for the online transactions such as transfers, bill payment, or airtime purchase? Also, you can ask whether there is a limit on free transaction. This is to mean that there could be a threshold for a number of transactions you are allowed to transact with 0 fees.